Let me talk a little bit about the importance of the constant net asset value money market fund to the European economy and reinforce some of the things, again, that Jennifer said about 500 billion or half of the 1 trillion euro money market fund industry is composed of constant net asset value products. What do we invest in? About 39% of the marketplace or of the funds are invested in commercial paper, 42% in banking deposits. This includes very short-term, very long-term banking deposits, long-term from a money market perspective being 12 months. We have about 10% in floating rate notes that are mostly coming from banks and corporations and financial institutions. Another 9% from a repurchase agreement perspective. And here let me talk a second about what we would consider repurchase agreements and the traditional collateral that goes behind them. And this is in contrast to some of what Mr. Carruthers was saying regarding SEC lending and the non-traditional collateral that was being used in some of that marketplace from a shadow banking perspective. The non-traditional side of the equation would only come into play with a money market fund is if the counterpart were the diversified entity, and the diversification then would be counted to that counterpart, not to the equity collateral or the mortgage collateral that would be behind that. So traditional repo is the goal of money market funds, and that's really all that can be used and called repo within those products. And then another 1.5% to 2% is in traditional government types of securities. Generally speaking, this group of asset composition provides more competitive and lower cost funding for the issuers that we are financing in this sector. Let me take a second to explain this slide because it wasn't clear to me what we were saying when we first put it together, but I'll hopefully be able to do that quickly for you. Implications to the European economy if CNAV money market funds are disallowed or are basically rendered out of business from having a capital requirement that is uneconomic in the marketplace. This was a survey that was done of European investors in money market funds. Those European investors included local governments, it included charities, it included universities, and it included the corporate sector from a borrowing perspective. It was done by a firm called Treasury Strategies, and effectively what they asked was, if CNAV funds are no longer available, where will you put those funds? Where was that $500 billion that you have invested in that product today? Where will it go? And the reason the slide was not necessarily transparent to me initially was I looked at this and said, well, this adds up to way more than 100%. How can that be? And the answer was they were able to give three, kind of number one, number two, and number three. So first of all, I think what you want to take away from this is that it wouldn't go to all one place. There are probably various pockets that would be recipients of the cash that would be displaced from the money market sector. The vast majority, though, listed European banking deposits as their number one repository for CNAV funds if they were no longer available in the marketplace. The next largest category, other short-term investments, probably would be the VNAV industry, although it wasn't specific in its questions. Money market funds in other domiciles outside of the EU that would maybe still be using the constant net asset value product. Banking deposits of other, not European institutions, private accounts, outside managers. The end result is there's a reason why these underlying investors need a constant net asset value product, and they need to have their cash invested for them on a daily basis. That need doesn't go away just because the regulatory environment might cause the product that they're using to change. The need still exists, and so it has to find another home. And this is basically the result of, at least from a Treasury Strategies perspective, where their underlying clients would expect to replace their investments from a CNAV standpoint. We do believe that the adverse effects of not allowing CNAV funds or having capital that basically drove CNAV funds out of business would be far-reaching from a European perspective. We do believe it increases systemic risk. As I showed, 72% would go into banking deposits in the European Union, and they're most likely the banking deposits of the largest institutions that are already considered more systemically risky within the overall environment of money market products. We do believe there's less regulatory control. From a transparency perspective, money market funds are already providing information on a regular basis, and we think some of the ESMA reporting that Mr. Conrad talked about with regard to the proposal would be hugely beneficiary in the context of making that reporting more reliable from a consistency perspective. So Fund A, Fund B, Fund C are all reporting, columns of A, B, and C the same. And also from a timing perspective, making it more relevant on a regular basis with what's actually being held, making the regulator as well as underlying shareholders more aware of the information that's held within these funds. We think there would be sharply reduced capital formation. Honestly, the underlying customers that are being funded or using money market funds from an investment perspective are not the traditional banking customers. And they would have to go out of their way to kind of find a different pocket to lend to those underlying institutions. And as such, it's probably something that would be more expensive for those entities and result in higher borrowing costs for them. We do think ultimately lower returns to cash investors would be the answer here. And in fact, part of the Commission's anticipation was that with financing costs or with capital costs as they were being proposed, the likely increase in fees for money market funds that continue to maintain the constant NAV would be anywhere from 9 to 30 basis points annually. Now, I'm not sure how many of you have used money market funds from a euro perspective, but most of them aren't earning 9 to 30 basis points. The interest rates from a short-term perspective that we can invest in the United States and Europe are both abysmally low and have been so since 2007. So to try to wreak out another 9 to 30 basis points means it's increasing the waivers back to the product provider or the sponsor, in my case, Federated Investors. We just released our full year financials for 2013. We already waived $250 million worth of fees from our money market products. Do we want to waive another 9 to 30 basis points on the $271 trillion that we manage? I can tell you it's probably not a positive story. We do think that money market fund safety and stability will be enhanced through the various innovations that we've seen with regard to product and composition changes, and we don't think that we need severe market disruptions that something like the capital requirements or complete ban would bring. Gates and fees were mentioned by Jennifer. They're not all created equally. There's devil in the detail. Key components to how those work is probably something that would need to be reviewed by investors before buy-in was brought. But we do think that there are other alternatives that, again, improve the resiliency without killing the product. And then my last slide talks just simply about some of the common misperceptions about CNAV funds, and I thought this is a great way to end up. A lot of people think CNAV funds are more prone to investor runs than variable net asset value funds. That's been proven to be incorrect and false. Basically, the same have, on a percentage basis, a relatively similar redemption history. Amortized cost as an inferior method of pricing money market funds, again, false in the context of fluctuations between amortized cost and mark-to-market pricing. It's to the thousandth of a penny, not to the penny itself. So it's something that, again, is misunderstood and oftentimes brought into a proportion in the marketplace in a way that makes people think of danger zones when, in fact, the comfort and safety around that $1 and the ease of that $1 or €1 or £1 sterling price is something that the market has come to rely upon and should be comfortable with.